Hello, hello. There is nothing in this universe that can't be explained with coffee, right? And the WACC is no exception. So the weighted average cost of capital is a metric that you typically see usually with DCF models, and sometimes it doesn't really make a ton of sense. Like you see a mathematical expression that includes debt and capital, and what is this about? I'm going to explain it in a manner that you will remember forever. Trust me, it's going to be that simple. Now, the WACC means the weighted average cost of capital, but what does that really mean? Think about this scenario. Let's say that you are buying coffee every day for a week, like 5 days of the week, and you have two options, a fancy cafe and a gas station cafe. The fancy cafe costs about $6, which is about $3 less than a typical Starbucks coffee these days, and the gas station costs $2. Now, if you actually buy one of each every day, the average is 6 plus 2 divided by 2 is going to be $4 that you pay on average for these two. So $4 is the cost of one coffee. However, let's say that you typically buy the gas station coffee, and once in a while, like Fridays, the end of the week, you want to reward yourself, you buy the fancy cafe coffee. And so now, for 80% of your days, 4 days of the week, you buy this one, 20% of your days, 1 day of the week, you buy this one. So your real cost is not going to be $4 anymore, and you can already see that you mostly buy this one, but it's going to be 20% multiplied by 6, this is this cafe. So 1 day you buy this one, 80% of the days, 4 days you buy and pay this one, so $2. So now the average is $2.8 per coffee cup, agnostic coffee cup out of these two. So this exact situation is your weighted average cost of coffee for you. It's exactly the same thing. Now, if we take a look at the weighted average cost of capital, it works the same way but for capital. And companies require coffee, but they mostly require capital. And so what is this capital? What is this cost of capital? And what do we mean by this? Now, when I'm getting money from somebody, this other party needs to get some money out of this. Like for instance, they lend me money, so they have to get some interest back. This part is the debt portion of the equity and of the funding of the capital. And so capital typically has these two ways of these two sources, pretty much, debt and equity. When we're talking about debt, think about it like getting a loan. Or think about it like convertible notes, for instance, or bonds. Typically in the market, the cost of this, like if I get some money, I need to pay back 5% of interest. The cost of equity, on the other hand, is when I'm actually issuing shares as a company, how much money my shareholders expect out of their investment, because they paid some money out of their own pocket now, in order to get some equity for the company, so they want to get something back out of it. Like, what are they getting back? So these two together is the source of funding for the company, and it's the same situation. Like, consider this example here for a company that 30% of its operations are funded by debt, and 70% of its operations are funded by equity. It's basically the same situation here as the coffee. So they are buying the cheaper coffee more here, and the more expensive coffee here. Now, 30% of the debt is 5% cost. Remember, this is the weighted cost of capital. It's about the cost. So 5% cost out of 30% of the total is debt, and 70% of the cost is equity, but this one costs 12%. It costs $6 when you compare it to it's the more expensive one. And so now the WACC is not the average of these two, it's the weighted average. So it's not 8.5, it's 9.9 in this situation, it's the blended cost of money. And you may be thinking, okay, why, if I'm a company, if I'm an investor, why do I expect 12% return here? And so the reason for this, and I have explained it in my previous videos in the past a lot when I'm doing the DCF model, is that when I'm an investor, I'm looking at other potential avenues of getting money. Like I'm looking at bonds, and bonds typically pay something like 5%. They have no risk. Like US government bonds, I don't have any risk. Like I just buy them, they will never go bankrupt. It's super unlikely. And the next one is going to be something like the S&P 500 index fund, which in the last century has been making about 10% on average every year, regardless of any crashes that have happened in between. So it's going to be 10% every year on average. And so, as an investor, if I'm buying a single company, because we're talking about the capital structure of a company now, of a single company, I expect more. I expect like 13%, 12%. I expect more than 10%, which is something that I get in a less riskier manner. And so, this is where this comes from, this expected return. And so, when I was making these pages here, or this academy sort of, I was thinking, what does my viewer ask next? And I think the next question that makes sense is, why not use 100% debt? This is cheaper, right? Why do you need this portion? There are a few very, very solid reasons for this. The most important one is that debt has to be paid back. So you owe money, you owe interest payments, right? However, the equity, you don't have to pay back. You just issue shares. Now, you have other disadvantages when you do that, but it's much cheaper for a company. Practically speaking, don't look at this. It's practically speaking much cheaper. And also, if you miss a payment, you can go bankrupt if you miss an interest payment, or you can have an agency downgrade you. You don't want that at all. This will have a deep effect in your stock, for example. And also, there's another thing. If you are a new company, for instance, and you are asking for debt, the banks are not going to give you an unlimited supply of debt. They're going to have their, risk assessments of their own. They're not going to be paying a ton of money to new companies. It only makes sense. It's the same with a family, right? But in a higher scale, a larger scale. So, stable businesses, like for instance a utilities company, they can handle more debt, and banks love them typically because they have payments that are more or less the same every year. So they get about the same revenue, about the same net income. So the banks know what to expect. But unpredictable ones, like for instance Palantir would be, especially when they were just beginning, they would rely mostly on equity to fund their operations because it would be cheaper for them and would be easier for them to get this money from. So now I think hopefully it makes a ton of sense for you. It's going to be much, much easier to remember what this means, right? It's more intuitive than actually seeing this kind of mathematical expression here, not knowing what it means. And this is what I try to do with the Academy. Now, to close this video, to finish this video, I wanted to take it back to Google's DCF model, which is the discounted cash flow models, and just quickly explain why we use something like 13% or 8%. What is the significance of it? Because online you will see two models. Some people or some websites will be using 13%, 12%, others could be using 8%, the WACC, 9%, something of that sort. So why? What's the difference? Now, if I run Google with 13% here, which is what as an investor would want, remember what I told you about earlier, I want something like 13%. Now I'm going to be getting lower values here. So I'm going to be getting lower expectations, lower intrinsic values. But this kind of required return answers the question that I have as a retail investor, and the question is, how much money am I willing to get as a required return for the company annually, as an investor, that is. Now, if I used 8% here in all this, let's say that this was the WACC of the company and I calculated it, and it's probably something like that for Google, I would assume. Let's say that we got 8% here. Now the question changes, flips itself. It's not about what I want as an investor. Remember, it's about the weighted average cost of capital for the company. So this is something that like an analyst would ask. So, what is the fair market value for a company right now based on their capital structure is basically the proper question, the proper way to ask it now. Now, if you do this though, remember you are adding the debt portion to it, because now we have debt plus equity. It's not only my equity portion. So in order to do my equity portion, we kind of need to exclude the net debt here from the calculations if we want to do it the precise way, the mathematical accurate way. But still, if we do it like this, you'll see that we are going to get some much higher value here. And this is because we have lower expected returns, and so the cash flows are readily more available, so they're going to be more. And so now we are getting about $300, much closer to the current market price with the high estimates here. And you see the finer details here. You see what all this means, and now hopefully you understand exactly why you need to use the WACC or why you need to use the a required return that makes sense. And in my model, in my tool, I prefer to use the lucky 13, as I call it, because it makes more sense for the investor. But you got to remember, even if I see a low value here, even if I see $130 for Google, a company is not only its cash flows. Cash flows are important, very important. They play a significant role, but there are so many other things that I'm talking about in the videos, including how much the company grows, how much debt they have. It's a lot of things that I go through in my video. We look at a ton of different things to decide whether to buy a company. But this is a good way to know how the company is doing in terms of cash flows, and if it makes sense for for paying this amount of money, like 320 in the market, in the open market. And also, there are other things as well to take into account that I have tried to include in the tool automatically to help you with your evaluations without you having to dig deeper. Telling you that this company, for instance, is using moderate capital intensity, meaning that they spend a lot of their cash flows for capital expenditures. So they are expanding. And of course, if you combine it with something like the AI deep dive that I have here, the framework, the tool here tells you a ton of different things. They will tell you exactly what this means and how it's used, because there's like big growth, big overhead, $30 billion in data centers. You see the full story, right? But, this is not the point of the video. Thanks for watching. You see how easy it is to explain things with coffee? It explains everything. It's a sort of a weird thing. Thanks for watching, guys. I'll see you in the next one. Bye-bye.